All right, so we're going to look at adjustments, but we need to understand the format of the income statement and the balance sheet. Just a recap from the previous classes we have. To start with, if we are setting up an income statement, the income statement for the period ending, you put the date there. That's how we write the title. So we have the debit side and the credit side. Okay. And this is just a working column. So we start with our sales, less sales returns. The figure that we get there is our sales turnover. So the first column of the income statement is called our trading account. The job is to produce what we call the gross profit. So from the turnover, we need to subtract what is called the cost of sales. So sales minus cost of sales will give us what? The gross profit. So from our cost of sales, we have opening stock, we add purchases, less purchases returned, add direct expenses like carriage inwards and customs duty. The total is the cost of purchases. This we add it to our inventory to get our cost of inventory. So when we less the cost of inventory, we less closing stock from the cost of inventory. The figure we get here, we subtract it from our sales to get our gross profit. To the gross profit, we can add other income that would include discount received, commission received, a decrease in bad debts. So this is our new gross profit. From the gross profit, we always subtract our operating expenses, such as carriage outwards, discount allowed, wages, rent, bad debts, depreciation, light and heat. So if our expenses are more than our gross profit, we call it a net loss. If our expenses are less, we call it a net profit. Now, when we're dealing with the cost of purchases, we usually add the purchases figure plus the direct expenses, which include carriage inwards, because that is the value when goods are brought in. You also add VAT. So we looked at an example where we're given following open transactions: opening stock, sales, purchases, returns, discount allowed, returns inwards. So we're asked to formulate the income statement from this data here. So we know that there's discount received, which is a gain, and there's discount allowed, which is an expense. We know there's carriage inwards. This one is an selling expense. We also have carriage outwards. Carriage outwards, the selling expense. Carriage inwards is an additional direct expense, which is attached to the purchases. So we add this one to the purchases. What are bad debts? Bad debts appear when our debtors fail to pay our debts. And so we call them bad debts because we write them off. So in our lives, we have people who owe us that we write off. We know they have no capacity, no intent to pay. So in this case, we're going to look at that format. So we start with our sales. We less sales returns to get 24,500. Then we go to the cost of sales. Our opening stock, we'll put it there. Purchases, we less purchases returns. The figure, we put it there. To the purchases returns, we're going to add carriage inwards. This is direct expense. If we had any customs duty, would have added it. So this is the cost of purchases, which when we subtract, we add actually to the opening inventory, and we subtract our closing inventory. What we get is called the cost of goods sold, or the cost of sales. Subtracting the cost of sales from our turnover gives us a gross profit. To the gross profit, we can add our discount received. This is our new gross profit. Then we subtract our indirect expenses like discount allowed, discount, carriage outward, salaries, rent, as is appearing in. And when we subtract the total expenses from our gross profit, we get our net profit. So I gave you an example or a class homework to try. Now, before I go to the class homework, because the class homework has figures that will relate to even the balance sheet. Now, the balance sheet has its own format that we also discussed. The balance sheet fulfills the accounting equation, which simply says our capital must be equal to, our assets must be equal to capital plus liabilities. So this is the format in which the balance sheet is outlined. We start with the fixed assets, which include land, buildings, fixtures, and fittings. When you total them up, this is our total fixed assets, which are tangible. Other fixed assets, which are intangible, of goodwill and development cost. These ones are fixed assets. We also have long-term investments like shares in another company. These are also fixed assets. So this is a total of our fixed assets that we have. Then we go to the current assets, which are ordered in order of liquidity: cash in hand, cash at bank, prepayment, receivables, and inventory. So when we add the current assets plus the fixed assets, what we get is the total assets. So we have done the first part of the accounting equations. Assets is equal to capital. So capital and liabilities, we started capital at start. We add the net profit. If there is a loss, we subtract it. Then we list the drawings. This is our capital. So capital. Drawings usually reduce capital, that's why we subtract them. Then we add the liabilities, the long-term liabilities and the short-term liabilities. The short-term liabilities are called current liabilities, and the long-term liabilities are called non-current liabilities. So if it's a loan which is more than a year, that is a non-current. So put a loan there. Okay. Then the current liabilities, we have creditors, accrued expenses, bank overdraft, taxation. So together, this figure must do what? Must balance up. That's why we call it a balance sheet. We looked at an example here where we have figures that are given that will be placed in the balance sheet. So all these figures, we have capital, profit, insurance, prepaid, accrued expenses, and accrue receivables, which are debtors, tax payable, these are current liabilities, motor vehicles, fixed assets, bank overdraft, liabilities, closing stock. This is our current asset, cash at hand, drawings, and the 5-year loan. So to prepare them using the vertical format, we start with fixtures, premises, and motor vehicles. So these are our total fixed assets. Then we go to the current assets, cash at hand, prepayment, receivables, inventory. So these ones, we total them up. So to get these are current assets. So we have our total assets. So we have A to be equal to financed by capital. We add the net profit, we less the drawings. So here, this is capital that we have, which is 51,000. Plus the liabilities, which we have the long-term liability, 5-year loan. The current liabilities, we have payables, bank overdraft, taxation, and accrued expenses. So this figure here must balance up with this figure here. That is why we call it a balance sheet. Are we together? Now, we'll quickly go to the homework that we had, which has both elements of the balance sheet and elements of the income statement. So before we go to solving it, I want you to help me identify which elements go to the balance sheet, which elements go to the income statement. Capital at start, where does it go? Balance sheet. Of course, you identify that some of the items will go in both. The trade payables, where do they go? Balance sheet under current liabilities. The sales, the income statement under the trading account. Returns outwards, these are purchase returns, income statement. Discount allowed, income statement.
Income statement.
Discount received. Income statement.
Income statement.
Fittings and fixtures at cost. Balance sheet.
Sheet.
Depreciation of fittings and fixtures.
Income statement.
Balance sheet and the income statement.
Income statement.
Both. Trade receivables. These are data, so this is the balance sheet. Inventory. So you need to know whether this is closing inventory or opening inventory. So there are two inventories there. This is June 30th, 2024. This is July 2023. So this is the opening inventory. So this one just goes in the income statement. It doesn't go to the balance sheet. This one goes to both income statement and the balance sheet. Then purchases, income statement. Returns inwards, income statement. Outwards, income statement. Drawings, where do they go? Balance sheet. Right inwards, income statement. Rent, income statement. Fittings and fixtures, all these are expenses up to here, income statement. But the bank, cash at bank, balance sheet. These are current assets, balance sheet. 5-year loan, balance sheet. All right, so the key thing is firstly identify where are these for. And now let's start posting. So if we're going to post those things, we start our sales was 280, we subtract our turnover. Our less returns inwards 5,000. So the turnover is 275. Then we got the cost of sales, opening stock. So here there were two stocks there. We pick 135. This one is the opening stock. Or you need to know which one is that. So we picked on this one here, 135, because it is opening stock. So that is where the figure is coming from. Then less purchases returns, then you can add the carriage inwards. So these are cost of purchases. We less closing stock. This closing stock appears in both. So when subtract the cost of the closing stock, this is called the cost of what? Sales. So we subtract the cost of sales from our sales turnover to get our gross profit. Since we had discount received, we add it. So this will give us our new gross profit. The gross profit, we're going to subtract our expenses, which are operating expenses. We start with what? A discount allowed, depreciation. This one appears in both. So depreciation affects the cost of the fittings and fixtures. So it will give us a less net book value by the amount. Then we have carriage outwards, 4,000 rent, rates, insurance, lighting, postage, up until the bad dates. All these are operational expenses. When we add them, 98,000 from 110, we get our net profit, which is 12,400. So this one will also be transferred to the balance sheet. Now, when we go to the balance sheet, it is read as at. We go to the income statement, it is read for the year ended June. So this is the format which we use when we are giving the titles of these books. Take note. So we had fittings and fixtures, 120. It has depreciation, 12,000. The net book value is the difference between the cost and the depreciation. Then we go to the closing stock under assets, closing stock, receivables, cash at bank and at hand. You total them up. So this, when we add the fixed assets to the current assets, we get the total assets, which is our A. Financed by capital, we add the net profit which we got. So if your net profit or your profit is wrong here, 12,400, it is also going to be wrong in the balance sheet. So this is a profit that we add here. Then we subtract our drawings to get 116. So this is our capital. So it should be equal to capital plus liabilities. The liabilities will have the long-term liability and the short-term, which are the current liabilities, payables. So when you add these two, you add these three, the capital plus the long-term and short-term liability, the total here, 155. It should be the balancing figure. Same here, 155. So this is how we do the balance sheet. And this is how we do. Are there any questions so far before we look at the adjustments?
Yes, I have a question.
Yes, please.
Maybe you can scroll up a bit on the, I think on the beginning of the balance sheet. Yeah, just there. I just want to understand the fixture and fitting 120 and 12,000. So why are we putting the actual value of fixtures and the depreciation value?
So what happens is we want to calculate, the balance sheet shows us what we own as a business, the assets that we have. So
Yes.
the balance that we have using the straight line method is simply the value that we bought it for, then the depreciation is a wear and tear. This fittings and fixtures has lost value by 12,000. So we cannot value it at 120,000. It is less by 12,000 because that's depreciated. So depreciation is a cost which reduces the value of your particular fixed asset. So here we're going to have 108 as our net book value.
Okay, I get it. The other question is the last one where we have the total 155 without exclusive of the liabilities. Then we have the same total after the addition of the liabilities. I need to understand why is that.
The accounting equation simply says assets must be equal to capital plus liabilities. So assets, the total value for assets is 108 plus 47, which is 155. On the asset part, we are done, 155. Then how much is our capital? Capital at start, add net profit, less drawing is 116. So it was 116. The liabilities, we know we have two types, the current and non-current liabilities. So what was our current liability? 20,000. What was our non-current liabilities? 19,000. Together, this is 39. So 39. So when we add these two, they're giving us 155. It's balancing. That is where this is coming from. Because when we added this plus that, it's giving us 155, which is what we have here as 155.
All right. So it should always balance like that.
Yes,
The
it should always
total.
balance.
Oh, okay. All right.
That's why it's called a balance sheet. All
Mr.
right.
Collins, I had a question. Well, there's what? Inventory. You said, is it inventory?
There's closing and opening inventory. So the closing
Yes, I think
inventory, the inventory that we remain with at the end, which is part of our current assets because that is what we can physically have. We don't have opening. Opening is what we started with. Maybe we started with 100 boxes of sugar, and now we're remaining with 20 boxes of sugar worth 17,000. So closing inventory is what we own, what we have. Here, the opening inventory only appears in the income statement. We want to calculate what we remained with. So we started with 50,000. We added some purchases there, and we retained some things. We brought in purchases there. Then we subtract what we remain with to know how much the cost of these sales are. So opening inventory only applies in the income statement.
Clear. I think I've just mistaken. There's one item which you said it appears both in the income statement and in the balance
It's a
sheet.
closing inventory, this one here. The closing
Oh, it's the
inventory,
same one.
yes,
Mm.
17,000. It is here. Then we're also going to have it. Well, that's what we have. Closing inventory 17,000. That is the one we have here. It appears in both.
Okay. All right. Thank you.
Right. Okay. So let's try to answer a few questions from the can you remember? Number one, what is a balance sheet? A list of all assets and liabilities of a company, a statement of the worth of a business, a statement that shows how assets of a business have changed over time, a statement of assets and liabilities of a business at a point in time in the financial terms. What is a balance sheet?
D.
B, statement of the net worth of a business. Do you agree with
D.
B? A statement of assets and liability of a business at a point in time in the financial terms. Point in time. Yeah, do we agree with him?
Yeah.
So the point in time, yes, it's correct, because point in time is as at. Then we go to the next question. Fill in the blanks. Dash and dash are examples of long-term liabilities. What are some of the examples of long-term liabilities?
Building.
Buildings,
Machinery. Sorry, Collins, I mixed up.
long-term liabilities. Which are the examples of long-term liabilities here?
To try, maybe loan. It does.
Okay, so what are examples of long-term? Mortgages, debentures, bonds, these are long-term. For 5-year loan. Which one of the following is not correct? A correct asset. Machinery, stock, prepayment, debtors. Which one is not?
Just a minute. I just want to be clear on the examples you have just given us. There's the
Debentures, these ones take more than 1 year. A debenture, a mortgage, a 5-year loan, all these are examples of
yes, those I'm clear, but I just want to be clear on the bond, because a bond is more like an investment, isn't it?
it's a long-term debt instrument which is issued by government or a company. So when a company issues or buys a bond, it's borrowing money. You have to pay in a long-term basis. You can't pay it within a year. It's like a loan. Yeah, it's a security. These I'll teach you in corporate finance more about that, but just know it's a long term. Yeah.
Okay. All right. Thank you.
So which of the following is not a current asset?
Machinery.
Machinery. What is it instead?
It's a fixed asset.
Fixed asset, correct.
It's a non-current asset.
Yes.
It's a non or fixed current asset.
It's a fixed asset. All right. Which working capital is another term for net assets. True or false? It's true. Huh?
True.
Net assets is another term for working capital. True. Gross profit is best described as what?
D.
Sales less purchases of stock.
D.
Sales less cost of goods sold. Yes, D, correct. Three sources of income other than a sale of a good which may appear in the income statement. Which are the three?
Discount received,
Yes, discount received,
commission,
commission received, and the decrease in what? In
decrease in
bad debts.
bad debts.
4 items which might be included in the selling and distribution expenses. Examples of 4 selling and distribution expenses.
Carriage outward,
Right, outwards, correct. Advertise.
purchases,
No, not purchases. Selling and distribution expenses.
marketing,
Marketing, correct. Salaries of salesmen. Yes. I'm glad you are very attentive. Everything I say, these are called principles of accounts, so you cannot guess if you don't know. So salaries of sales staff, commission of sales staff, traveling, entertainment of sales staff, marketing costs, advertising, carriage outward. Okay. Examples of other income: discount received, rental income, if we own, we have interest on dividends received from other investments, a sale of a fixed asset. All right. So now we need to understand the distinction between capital and revenue expenditure and examples of capital and how we treat them before we go to the adjustments. Already 4 p.m., 2 p.m. All right. So expenditure means we are spending money to acquire an item or a service. And so the type of item that is acquired is called capital expenditure or revenue expenditure, one of the two. Now, when we're dealing with capital expenditure, it means we're buying fixed assets, which are adding value to a firm, called capital expenditure. For example, if you're buying land, buildings, vehicles, that is capital expenditure. Also, when you're adding value by spending money on an already existing asset like painting, renovations, these ones also increase the production capacity. So this also falls under what? Under capital expenditure. Other capital expenditure that we may have can be included on expenditure amount on non-current assets to put them in a workable condition. For instance, the car was in the garage, you have bought wheels to it, transport costs to bring them into the premises, legal expenses in acquiring buildings, all those are capital expenditure. When we're dealing with revenue expenditure, we're looking at operational expenses to run the day-to-day businesses. So these ones may include repairing a machinery, replacing broken windows, paying electricity, paying petrol for running vehicles, buying stationery, purchase of goods for resale. These are called what? Revenue expenditure. So people must understand that revenue expenditure, they go into the income statement. Capital expenditure, they go into the balance sheet. So what is to be called capital revenue expenditure will depend on what the business is dealing in. For instance, if the business is buying and selling vehicles to sell, make a profit, we can't say vehicles, those ones are capital expenditure. No. The revenue, because stock is our vehicle. So a vehicle will be regarded as what? Inventory. So you need to know the nature of the business that you're dealing with. All right. So having that in mind, we can now go to adjustments. So adjustments are very important in accounting because this is where the accruals or matching concept comes in. Any questions before I look at the adjustments? No questions? I will go to the adjustment of final accounts. Now this is where it becomes important and tricky because you need to know the accounting concepts that we had in lesson 2. And apply them appropriately. Okay. So black shoe. So final statement with adjustments. We'll look at the balance sheet and the income statement. So in here, we'll be able to understand the correct treatment of prepayments, accruals, bad debts, and provision for depreciation. So we have an example here. Shoe Black is a sole proprietor and has the following trial balance. We have distribution expenses. We have 10% loan. If you have 10% loan, and this is 1,000, it means the interest payable on this loan is what? 10%, which is 100. So if in the adjustments, you only paid 50 kwacha of this, the other 50 kwacha will be treated as an accrual. If you paid the whole 100 kwacha, then there are no expenses as we have. Trade payables are creditors, they're always on the credit side. Cash at bank is a current asset, all assets have a debit balance. Allowance for doubtful debts is 18. Now, every business makes an allowance for doubtful debts based on our debtors figures. So if we have debtors which are amount receivables, for instance, this is 810, and we are told that we make a provision allowance that maybe 10% will not pay. So 10% of 810 is 81. And how many people have not paid? 18 have not paid. So meaning there's a reduction. Instead of 81, 18 have not paid. So that reduction, we add it to the what? To the other income. But in the case where we had 100 as an allowance for doubtful debts, there would be an increase in provision. So instead of 81, we have 100. So we'd have gone up by 19 kwacha. So that 19 kwacha is called an expense. So it's called an increase in the doubtful debts. Motor vehicles at cost is 1680. Now, whenever we're considering depreciation, there are two costs on depreciation. So motor vehicle is 1680, and the depreciation for motor vehicle is what? 620. And listen to me carefully. If they ask you to calculate depreciation 10% at cost, just calculate 10% of 1680 is 168. That one is what you charge in the balance sheet. Well, that's what you charge in the profit and loss account under other income, other expenses. But if they ask you to calculate using reducing balance method, this is what you do. So motor vehicle, let me start again. We're told, for instance, it is 10,000. That is the cost. And they ask you to say the depreciation on motor vehicle is 1,000. There are two types of depreciation that you're going to calculate. Number one, on cost. Let me just put 2,000 here to avoid figures. So if they ask you to calculate depreciation on cost, 10%. So just calculate 10% of what? 10,000. What is 10% of 10,000? So depreciation that you're going to have in the income statement is 10% of 10,000, which is what? 1,000. But if they ask you to calculate on reducing balance, it means you don't calculate directly on the cost. You just subtract the depreciation that has been accumulated. So 10,000 minus 2,000, what do we get? 8,000. That is our NP, the net book value. So 8,000 here, and then you calculate 10% of this 8,000, which will be depreciation. Then the income statement will be 800 kwacha. So this is the only thing that you need to understand. But when we are going to the balance sheet, the depreciation figure which appears between the accumulated depreciation and what you calculated is both of them. If you're using reducing balance method, you add 1 pin plus 2 pin, it will be 3 pin. So the net book value in the balance sheet will be 7,000. If you're using depreciation on reducing balance, it's the 800 plus the 2,000. So you subtract the 2,800 from the 10,000, then you get 7,200. So I'm just preempting what I'll explain here in advance. Same, we're given accumulated warehouse at cost 1,800, accumulated depreciation 290. We have buildings at cost and accumulated depreciation, land, accumulated depreciation. Then interest on the loan paid. This is what we actually paid. But if you see here, 10% of 1,000, which is what? 100 kwacha. So meaning we only paid 50 kwacha. So meaning the other 50 kwacha is owing. And this is something small, which can be paid within a year. So this is called an accrual. But using the accruals concept, which says you already enjoyed the bank service. You can't charge 50 kwacha in the income statement. You charge the whole 100 kwacha, which was supposed to be paid. Wages, 1,590. These are all what? All operation expenses. But if there are any wages that we, in the adjustments, we do not pay, we usually add the accrued expenses. You add accrual. If you prepaid, we subtract the prepayment because we have not yet enjoyed. For instance, if we had insurance that we paid in advance, we subtract it. Here we have discount received and allowed in the same line to confuse you now. So which one of the two is an expense and which one of them is not an expense? So all expenses have a debit balance. So obviously this is discounted allowed. Discount received is a gain. So this is the 100. Coincidentally, they are appearing in that order, but if we need to swap them, we need to know that the discount allowed is always in the debit because it's an expense. Discount received is a gain. We have carriage inwards and carriage outwards. One is on the debit and one is on the credit. Carriage inwards is same as sales returns. So subtract it from the sales. Carriage outwards is same as purchases retained. Subtract it from the purchases. Then we also have carriage inwards and carriage outwards. These are the returns inwards and returns outwards. These are purchases and sales returns. So both of them are expenses, except that one is a direct expense, which is called carriage inwards. The carriage inwards is actually added to the purchases figure. The carriage outwards is a selling and distribution expense, which is charged in the income statement. Inventory, January 1. This is usually opening inventory. The closing inventory is always found in the adjustments. Purchases and sales, we know how to treat them. Our capital, we know how to treat it in the balance sheet. Then we're given adjustments here. Closing stock is 166. Take note of the zeros here. There are more here because they're not zeroed out. These ones here are zeroed out. So please, those mistakes cannot be made by you guys. So there's a 0. So we're looking at 1660 if we're using the books of accounts. And we are told that trade balances totaling to 6,000 are to be written off. So this 6,000 is called a bad debt. And we're also told that allowance for doubtful debts is supposed to be what? Increased to 30,000. So the increase in bad debts. So here, if you're going to check, our allowance for doubtful debts is what? 18. But there's an increase to 30,000. So from 18 to 30, we have a 12,000 which has been added. So that is an increase. So we also told that salaries and wages owing is 190. So we need to subtract this 190 because we need to add this 190 because we enjoy the salaries and services. But also in these salaries and wages figures, we also have 70, which was paid in advance. So whatever we paid in advance, we subtract it because we haven't enjoyed the benefit yet. But whatever we enjoyed yet, we add it. Then we're also given selling and distribution expenses of 60,000 we prepaid. Anything prepaid, we subtract. But this prepayment is going to be reflected in the balance sheet as a current asset. 120,000 has not been paid for selling and distribution expenses. So this one, we're going to do what? Add it. We've already enjoyed it. Whoever has not paid. So this one is an accrual. So all these that are owing will also go under current liabilities. Interest owing is 50,000. So remember, I was supposed to pay 100, 50,000 have not been paid. Then we're told that invoices for credit purchases owing to totaling to 18,000 for goods delivered were not what? Invoiced. So purchases figure, we add this 18,000. It was also found that credit sales totaling to 7,000 were delivered before the year end. So we didn't have this 7,000. We need to add it back. When we go to our calculations, before we go to calculations, we also told that depreciation will be 2% on cost for buildings, 15% on warehouse cost, and 25% on motor vehicles on cost. So these ones will be directly calculated on the costs. So when we go to the calculations, remember sales, we had a 7,000 which wasn't added, we add it back so that we use the correct sales figure. Selling and distribution, we had an amount owing for 120, you add whatever is owing. Then what is prepaid, we remove it. So that the correct figure for selling and distribution is what? 1520. Purchases, we're told that there's an invoice of 18,000 which wasn't appearing, we add it. Interest, we are supposed to pay 100 in total, but we only paid 50 and the other 50 is owing. So we need to show 50. But this other 50 will go to the what? To the income statement as an accrual. Salaries, we're told that there's 190, which was not what? Which was owing. So put 190 owing. Then prepaid, we prepaid 70. So all prepayments are supposed to be done what? Are supposed to be subtracted. Then we go to bad debts. Bad debts affect what? Debtors. So our debtors figure was what? 810. We remove the bad debts of 6,000, so we get 804. But again, when we go to the balance sheet, so if we subtract the remaining receivables, which is 804, we add the omission of the 7, then we subtract the allowance for doubtful debts 30. So this is the new debtors figure. Then when you go to the buildings, we're told that 2% of cost. So trial balance, 2% of the building cost will be what? 166. So we add the trial balance accumulated depreciation, 1,200. So this is 1186, the total depreciation that will transfer to the balance sheet. But what we're going to charge in the income statement is only 166. Same, 15% of warehousing. This one only goes to the profit and loss account. Then the total, we'll put 90, is what is going to appear in the balance sheet as the total accumulated depreciation. Same with motor vehicle. So when we start our transactions, so the sales which has been already adjusted, we less sales returns. So this is our turnover. We go to opening stock, 1530. The purchases figure, we've already added the purchases returned and adjusted it. 8118. So we less returns outwards and add carriage inwards, less closing stock. We can do them together. Then what we get is a cost of sales. This cost of sales, we subtract it from our what? Our turnover. So we get our gross profit, which is 4996. We add other income. We have discount received, which is 100. So we have our new gross profit, which is 4769. Then we go to our expenses. We have loan interest. Remember, we only paid 50, but we should have paid 100. So putting the whole 100 there. So the bad debts, provisions, we have that we added 18. Salaries and wages, we subtracted the prepayments and added the amount owing. This is when we get 1710. Discount allowed, we have 8. Distribution expenses, we adjusted it, 1520. Carriage outwards, 250. Buildings, only the calculated on cost, 166, 270, and 420. So when we total them up here, we subtract them, and we're going to get our net profit, which is 235. Then we go to our balance sheet. So balance sheet, land did not have any depreciation as usual, it only accumulates. Buildings, we have 1168. Now this is a combination of two expenses. Here buildings, we didn't write 1168 because we only calculated the 166. But where is 1168 coming from? For buildings, it's coming because we had the trial balance figure, which was 1020. When we add the 166, we get 1186. So it is now accumulated depreciation. So this is where all these figures are coming from. Warehousing and motor vehicle, all these are accumulated depreciations. When we subtract them from their cost, then you sum up, these are the fixed costs that we have, the fixed assets. Then we go to our current assets. Cash at bank, 140. The prepayments we had, 130. The debtors adjusted figure, 781. And the closing inventory, which is 16660. This is our total current asset. When we add them, we get the total assets, which is 13,215. Then we go to finance by the capital start, 10,000. the net profit which we just calculated, which is 235. Then the long-term liabilities, we had a 10% loan, put it as it is in total, which is 1,000. And now the accruals. Remember, there was a 50 which we did not pay towards the same loan. The other accrued expenses for salaries, the other accrued expenses that we did not pay for. We add our accruals, trade payables, and we add these two. Our total liabilities are 1198. So this figure should balance up with our sum of capital and liabilities. So this is how the adjustments are supposed to be treated. And you need to take note that these adjustments will always come. You just need to try as many as can be to understand. So we end here. We'll continue later unless there are any burning questions. Thank you so much.